Hey guys, we're back, and in this video we share our February update of our $116,000 TFSA dividend stock portfolio. I'll share our 17 holdings and which stocks we bought in this turbulent market. Let's do this! For those that are not new to the channel, I'm sorry. But for those that are new to the channel, my wife and I do our finances together. We have 3 accounts through 2 brokerages for our TFSA, Scotia iTrade and Wealthsimple. As you can see in our Wealthsimple account, the month of February has been rough compared to January. We finished the month down 1.8% or $2,100. That's after the blazing start to the year, up 6.2%. I firmly believe the markets got ahead of themselves in January, as the rally that strong was unwarranted. Time reveals all things. So let's keep on the stock watch. Now for the update. Let's start with our one and only ETF in our TFSA, VFV, Vanguard's non-hedged S&P 500 index ETF. Since selling off most of our position, we have not made any purchases yet. VFV remained relatively flat despite the S&P 500 falling 4%. Thank you, Canadian dollar. I still see the index as overvalued. However, now I need to keep in mind the context of a devaluing Canadian dollar. VFV still makes up a tiny 0.2% of our portfolio. I have an allocation target of 5%, so I need to drop about $6,000 in there. Next, TD Bank makes up 1% of our portfolio. After buying 13 shares in January at fair value, no shares were added this month, as TD ran up again and was trading in the low 90s. I want to bring this to a 5% weighting, so I'll need 2 things: cash on hand and a market pullback. I'll look to add at the $83 and $79 ranges. Just an FYI, TD will report its earnings in a few days' time at the beginning of March. Next, CANOE EIT Income Fund makes up 2.6% of our portfolio. This income fund started the year well and then dropped 4% in February, despite all its big blue chip stocks in the fund. And with a portfolio weighting of 22% financials, 19% energy, and 16% healthcare, the energy side is becoming a real drag as gas and oil prices drop, and the financials have been hit hard too. I have a target allocation of 0%, so one day this will be sold, as I say, every single month. Next is ALGONQUIN Power and Utilities Corp. This is a renewable energy play in the utility sector. This makes up a tiny 3.6% of our portfolio. ALGONQUIN is up 20% from its lows in November. Just a reminder, January 12th was Investor Day, where management highlighted 3 keys moving forward. 1, realigning capital allocation and reducing capital expenditures. 2, refocusing the portfolio with $1 billion of additional asset sales. And 3, a 40% dividend cut. It looks like the market has reacted well so far. I expect the overall stock price to be in line with the dividend cut, so about 40% down from the $18 range, which gives it a $11 to $12 target. March earnings reports should start to give us investors an idea of where it is at with getting the debt situation under control. Hopefully we get some clarification on the Kentucky Power deal as well. They ain't giving up easy. They ain't giving up easy at all with that one. Before we continue, I want to do 2 things. Firstly, thank all of you who are supporting this channel and have joined us on Blossom Social. I'm really loving the space. It's great for new and seasoned investors alike. Join us on Blossom by clicking the link below if you want to follow our trades live. And secondly, I need to apologize for the slow release of videos. We have a massive backlog of videos we want to get out and just can't. My wife, who will eventually be editing this video like usual, was finally diagnosed with a chronic health disorder. So moving forward with YouTube will really be if Mrs. Financial has the energy for it. This community is pretty darn awesome, and I don't want to leave it. I thought it's about time I let you guys know what's been going on. So thank you for supporting us despite our sporadic video updates. I promise I'll keep recording, and Mrs. Financial will continue to do her thing when she can. Now back to the updates. Next up is FIERA Capital. It represents 4.1% of our portfolio. FIERA is now flat on the year after being up 7% in January. Q4 earnings were released this month. They were bad. Not as bad as I anticipated, with adjusted EBITDA decreasing 22%. I maintain my sell stance on this stock, waiting for some positive news to sell on. It looks like I may have missed the sailing on getting my $11.25 sell price. Next, we have MANULIFE Financial Corporation at 4.7% of our portfolio. We used to own a few stocks in the insurance industry, but as many of you know, no more. We have a 5% target weighting on this position. MFC is up 11.5% on the year, 2% in February alone. Quarterly earnings were good. A few highlights were the record net income of $7.3 billion, and they purchased for cancellation 4.1% of common shares outstanding for $1.9 billion. They also had record EPS of $3.68, which lowered their payout ratio to 35%. Also, MFC is continuing with the buybacks. The NICIB is set for 3% of outstanding shares. And lastly, the dividend increase we were all waiting for came to be. It was higher than I anticipated, with an 11% increase. That means MFC is blasting past my rule of 12 with a score of 17. I should be trimming my position, as I usually do, when it hits about $28. Next up, we have BCE Inc. at 5.3% of our portfolio. This is finally a smaller position than TELUS. We have a target allocation of 6% for BCE, though it should hover slightly less to allow TELUS to be the bigger position. It finished February down 5%. It also reported earnings, and they were okay. Nothing awesome to report and nothing bad to report. One highlight is that all financial guidance targets were achieved, and Bell Media actually increased its revenue. And the best part about the report was the 5.2% dividend increase they announced. Woohoo! We've been on a roll this month. If this drops to my cost average, I'll add to this position. I view BCE almost as a bond in the portfolio with a very modest 1.5% 5-year CAGR on its share price. Next up, we have TELUS Corporation at 5.6% of our portfolio, up from 5% in January. It is now a larger portion of our portfolio than BCE Inc., the media telecom sister. I prefer TELUS for its technology play. You may notice its 5-year stock price CAGR is more than double that of BCE. TELUS pulled back 5.5% this month after earnings. I love the targets they set for 2023 with adjusted EBITDA growth of 9.5 to 11%. We bought 27.51 shares at an average price of $27.87, around fair value. That added $38.64 to our forward annual dividend income at a yield of 5%. Next is our OG utility, FORTIS. It represents 5.8% of our portfolio. This has been weak to start the year, down 3.5%, but has been a solid performer over the years with a 5% CAGR on its stock price. I want to bring its weighting more in balance with CPX. It reported Q4 and year-end results. They were in line with expectations. FORTIS had 7% EPS growth and expects its long-term growth in rate base will drive earnings that support dividend growth guidance of 4 to 6% annually through 2027. We bought 7 shares at an average price of $54.10. This added $15.82 to our forward annual dividend income at a yield of 4.2%. Next, we have our first midstream pipeline, PEMBINA Pipeline Corp. It represents 6.4% of our portfolio. This is now flat on the year after a modest 2% increase in January. Q4 earnings were in line with expectations. The highlight being cash flow from operating activities up 11%. It'll be interesting to see how well it performs in this weird operating environment. One more thing to note, Mr. Ma was appointed to the board. He has over 40 years of experience in the oil and gas industry and was the CEO of Advantage Energy Ltd. No new purchases for us here. I haven't grabbed shares since December of 2021. Next, we have our OG pipeline, ENBRIDGE, at 6.7% of our portfolio. Pipelines have been slipping. This is down 4.5% in February, bringing its dividend yield to almost 7%. Q4 results were released and didn't do anything for the stock price. The main takeaway for me was that DCF, or distributable cash flow, hit $11 billion compared to $10 billion in 2021. So the dividend continues to be well covered. We didn't buy any shares yet, but we'll look to do so if it dips below $50. We're looking to bring this in line with our TRP weighting. Next up, we have SmartCentres Real Estate Investment Trust at 7.1% of our portfolio. This REIT is another staple in our turf portfolio and is up 2% year to date. This is overweight for our liking, as we have a sector allocation of about 16% for REITs, and right now we're sitting at over 20%, in part because of the run-up in the market and our constant drips. We still consider SmartCentres to be one of the top 4 REITs in Canada. Q4 earnings were not as solid as I'd like to see. The payout ratio improved to 88.9%, and they now have 19 properties under development with 48 expected to start in the next 2 years. We'll continue to add at or below our cost basis and trim if it runs up past our target price of $33. We bought 7.1 shares at $27.18, adding $13.14 to our forward annual dividend income at a yield of 6.8%. Next, we have TC Energy Corp at 7.3% of our portfolio as our last pipeline play in the energy sector. It is now up 3% to start the year. Not bad. Q4 earnings were not good in my opinion, but that's a quarterly thing. This may provide a good buying opportunity as this is trading a bit under what I consider fair value despite starting the year up. The major highlight from Q4 was the 3.3% dividend increase. Another one. The good news was that the CEO stated that they expect the positive momentum to continue into 2023 despite macroeconomic challenges, with 2023 comparable EBITDA expected to be 5 to 7% higher than 2022. The bad news is, Coastal GasLink pipeline is now expected to cost $14.5 billion. Yeah, inflation and poor project management are killing them here. So we bought 3 shares for $55.33. That added $11.16 to our annual dividend income at a yield of 6.7%. Next, we have First National Financial at 8.2% of our portfolio. So far, year to date, it is up 7% after the first 2 months and is now up 21% from its October lows. This reported Q4 earnings like the rest of our portfolio. They were pretty stable. FN reported record mortgages under administration of $131 billion compared to $123.9 in 2021. Also for 2022, the common share payout ratio was 73%, which is healthy. I'll look to continue to add as rate increases and the financial pressures mount. Good is bad, and bad is good when it comes to purchasing shares. Next up, we have our mid-cap utility, Capital Power Corp, at 8.4% of our portfolio. This has been pulling back lately, now down 10% year to date. This has been a steady performer, however, with a 12% CAGR on its stock price over the last 5 years and healthy dividend increases. Q4 earnings were less than stellar, and the stock price responded accordingly. CEO Brian Vaasjo said that 2023 started with one of the warmest winters in history, driving settled power prices well below expectations. As a result, average forward power prices for the year have modestly declined, resulting in Capital Power trending towards the lower end of their adjusted EBITDA and AFFO guidance ranges. We bought 7 shares and dripped one at an average price of $43.45. That added $16.24 to our forward annual dividend income at a yield of 5.4%. Yes, this is much more expensive than our average cost basis, but I'm okay with that given the size of the purchases and the fact that we sold $3,000 worth at over $50 a share. Second to last, at 9.4% of our portfolio, is Bank of Nova Scotia. This is our second largest holding, sadly. The share price was up 14% year to date at one point. Now it's only up 5%. Q1 earnings on the last day of the month were not good. It's not doom and gloom, of course. I'm not one for theatrics. The main takeaway for me was the provision for credit losses was $638 million compared to $222 million. That's an increase of $416 million. This isn't cash outflow, more of cash set aside. Let's hope it doesn't have to be used and can be released in the event of things aren't as bad as they expected. In any case, EPS came in well below estimates and about 14% less than Q1. We dripped 1 share at $71.18. This added $4.12 to our forward dividend income at a yield of 5.8%. And lastly, our heavyweight holder for almost 3 years now, RIOCAN Real Estate Investment Trust. It is 13.7% of our portfolio. It is now down 7% on the month after a strong rally to start the year, up 10% at one point. Q4 earnings were released and they were in line with my expectations. Full year FFO per unit was $1.71, an increase of 11 cents per unit or 7% over the prior year. The dividend was increased a modest 6% to 9 cents a month. The FFO payout ratio is still low at 59%. If RIOCAN hits their 2023 FFO per unit guidance range of $1.77 to $1.80, we can expect another half a cent raise next year. We were able to drip 2 shares at a price of $22.52 at the beginning of the month. We have a very low cost basis, so it doesn't bother me to leave the drip on. This added $2.16 to our forward annual dividend income at a yield of 4.8%. So there you have it, all 17 holdings we own and what purchases we made in February. We deployed a total of $1,924.25, adding $101.27 to our forward annual dividend income this month at an average yield of 5.3%. If you watched our February income update, you'll notice that we spent a lot more than we earned this month again. We have almost $60K in TFSA contribution room we're trying to use up on undervalued stocks. Thank you so much for watching and helping the channel out by smashing that like and subscribe button. Until next time, I'm Mr. Financial.